Hello friends, welcome back to my channel Course to Billionaire. This is my fourth video and this is a process of billionaire, road to billionaire, how to become a billionaire. Please subscribe my channel and share it because this is a informative video and you will learn how to become a billionaire. Today's topic is individual retirement account, IRA. This is a third topics, my fourth video but third topics. Starting individual retirement account, IRA. A tax advantage retirement savings account in which you contribute money that's already been taxed and it goes on a tax dividend basis. So what is an IRA? Why I would told about it? Because you will be a billionaire, then you will plan your life. Plan to go through your life for a billionaire. So what is an IRA? An individual retirement account is a savings account with a tax advantages that individuals can open to save the interest in the long term, like a 401k account that an employee obtains as a benefit from their employer. An IRA is designed to encourage people to save for retirement. Anyone who has earned income can open an IRA and enjoy the tax benefits that these accounts offer. Unlike a 401k, however, individuals can open an IRA without involving their employer. That's why they are known as individual retirement accounts. You can open an IRA through a bank, an investment company, an online brokerage, or a personal broker. Now the key takeaways, number 1 point is individual retirement account or retirement savings account with tax advantages. Number 2, types of IRA including traditional IRAs, Roth IRAs, simplified employee pension SEP IRAs, and savings incentive match plan for employees IRAs. Money held in an IRA usually can't be withdrawn before age 59 and a half without incurring a healthy tax penalty of 10% of the amount withdrawn. There are annual income limitations for deduction and contributions to traditional IRAs and contributing to both IRAs. IRAs are meant to be long-term retirement savings account. If you take money out early, you defeat that purpose by diminishing your retirement assets. How does an IRA work? Anyone with earned income can open and contribute to an IRA, including those who have a 401k account through an employer. The only limitation is on the combined total that you can contribute to your retirement accounts in a single year while still getting the tax advantage. When you open an IRA, you can choose to invest a wide range of financial products, including stocks, bonds, exchange-traded funds, and mutual funds. There are even self-directed IRAs, SDRIs, and that permit investors to take all the risk and to give them access to a broader selection of investments, including real estate and commodities. Only the riskiest investments are off limits. There are several kinds of IRAs, including traditional IRAs, Roth IRAs, simplified IRAs, employees pension IRAs, SEP IRAs, savings incentive match plan for employees, simple IRAs. Each has different rules regarding eligibility, taxation, and withdrawals. Individual taxpayer can establish traditional and Roth IRAs and small business owners and self-employed individuals can set up SEP and simple IRAs. An IRA must be opened with an institution that has received Internal Revenue Service approved to offer these accounts. Choices including banks, brokerage companies, federally insured credit union, and savings and loan associations. Because IRAs are meant for retirement savings, there is usually an early withdrawal penalty of 10%. If you take money out before age 59 and a half, there are some notable exceptions. Withdrawal for educational expenses, for example, and for first time home purchases, among others. If your IRS is a traditional account rather than a Roth account, you will owe income tax on an early withdrawal. Important things: you can only contribute to an IRA with earned income that meets the IRA definition. Income from interest and dividends, social security benefits, or child support does not count. What are the different types of IRS and their rules? Following is a breakdown of the different types of IRS and the rules regarding each one. Traditional IRA. In most cases, contributions to traditional IRS are tax deductible. So if you put $4,000 into an IRA, your taxable income for the year decreases by that amount. Then when you withdraw the money in retirement, it is taxed at ordinary income tax rate. In that way, your money grows on a tax deferred basis on the traditional IRA. For 2021 and 2022, the annual individual contributions to traditional IRAs cannot exceed $6,000 in most cases. If you are age 50 or older, you can contribute up to $7,000 per year. That extra $1,000 is considered a catch-up contribution. If you don't know the catch-up contribution, I will talk to you later. Or this kind of video will be published later. If you don't have retirement plan at work, your traditional conditions are fully deductible. But if you are or your spouse, if you are married, have a retirement plan at work such as 401 by K or 403 by B, your modified adjusted gross income determines whether and how much of your traditional IRA contributes can be deducted. In 2021, if you are single or files as head of household and have a retirement plan at work, your traditional IRA contributes are fully deductible if your MAGI is below $66,000. If you are married, filing jointly, your MAGI must be less than $1,05,000. From there, you begin to lose deduction as your MAGI increases. But warning that it is possible to have both a Roth IRA and traditional IRA or several IRAs, different institutions. However, the total contribution to all your IRAs cannot exceed $6,000 each year or $7,000 for those age of 50 or older. For 2022, the IRS changed the income phase-out range for deducting contributions to a traditional IRA for investors with retirement plan. At work, the phase-out range of married couples increased from $105,000 to $125,000. In 2021 to $109,000 to $129,000, and for single taxpayer or head of household from $66,000 to $76,000 in 2021 to $68,000 to $78,000. If you contribute to an IRA and are married to someone covered by a workplace plan, but you are not, that phase out range in 2022 goes up to the $204,000 to $214,000 from $198,000 to $208,000 in 2021. Use the chart to figure out where you fit. So I will show you the chart. If you single or head of household, Then to 2021 MAGI and 2021 MAGI. Please look out the differences between 2021 and 2022. That's $66,000 and $68,000. The full deduction up to your contribution level. More than 66,000 but less than $76,000. And the 2022 MAGI, the $68,000 then less than $78,000. If you married filing jointly, then it will be $1,05,000 and or less, or $1,09,000 or less. And this is the full deduction up to your contribution level. Married filings separately, this would be $1,25,000 or more to $1,29,000 to more, but deduction is no deduction. If you less than $10,000 and 2022 is less than $10,000, then partial deduction will be good. So you will be both Roth IRA or normal IRA. Roth IRA contributions are not a tax deductible, but qualified distributions are tax free. You contribute to a Roth IRA using after tax dollars, but you do not have to pay any taxes on investment gains. When you retire, you can withdraw from the account without incurring any income taxes on your withdrawals. Roth IRAs also do not have required minimum distribution RMD. If you don't need the money, you don't have to take it out of your account. You can still contribute to Roth IRA as long as you eligible earned income to, no matter how old you are. Roth IRA contributes limit for the 2021 and 2022 taxpayer are the same as their traditional IRAs. However, there is a catch. There is an income limitation for contributing to Roth IRAs. The phase-out range of single filter is $1,25,000 to $1,40,000 in 2021 and $1,29,000 to $1,44,000 in 2020. The married couple filings joint taxes phase-out range of $1,98,000 to $2,08,000 in 2021 and $2,04,000 to $2,14,000 in 2022. The income limits for contributing to a Roth IRA is the taxpayer, so you will be ignored if you are not taxpayer. This is a ACP IRA. Self-employed individuals such as independent contractors, freelancers and small business owners can be set by ACP IRAs. A ACP IRAs adheres to the same tax rules for withdrawal that traditional IRAs does. For 2022, ACP IRAs contributions are limited to 25% of compensation or $61,000, whichever is less. Business owners who set up ACP IRAs on their employees can deduct their contribution on behalf of employees. However, the employees cannot contribute to their account, and the IRS taxes with the withdrawal of income. Now the simple IRA. The simple IRA is also intended for small business and self-employed individuals. This type of IRA follows the same tax rule for withdrawal as a traditional IRA. Unlike ACP IRAs, simple IRAs allow employees to make contribution to their account, and the employer is required to make contribution as well. All the contributions are tax deductible, potentially publishing on business or employees into a lower tax brackets. The simple IRA employee contribution limit is $14,000 in 2022, up from $13,500 in 2021, and the catch-up limit for workers ages 50 and older is $3,000 for 2022, unchanged from 2021. What are the requirement minimum distributions? Starting to age 72, holders of traditionally IRAs must begin taking RMDs, which are based on account size and the person's life expectancy. Failure to do so may result on a tax penalty equal to 50% of the amount of the required distributions. In 2019, the Setting Every Community Up to Retirement Enhancement Secure Act increased the age requirement for taking RMDs from 71% to 72%. It also eliminated the age limit of which a person can contribute to IRA, which was 70 and a half. A person is any age with earned income can now contribute to an IRA. The comparing IRA types is IRA type employee contribution limit 2022 tax deductible contribution. What are the advantages of an individual retirement account? This is the main point of this topic. An individual retirement account IRA provides a tax advantage way to save for retirement depending on what type of IRA you use. An IRA can reduce your current tax bill either now or a retirement. Any investment gains are usually tax free. Also, IRA issued an Federal Deposit Insurance Corporation FDIC government run agency that provides protection when a financial institution falls. The FDIC covers customer deposits up to $250,000 per account in most cases that are held at FDIC insured banks for savings and loan associations. So how can I start for Roth IRA or traditional IRA? You can create an IRA at most bank, credit unions or financial services providers. Finally, Charles Schwab and E-Trade are all examples of brokers that provide IRAs. Opening an account is as easy to visiting their branch or website to providing your bank and tax information. When can I withdraw from an IRA? The best time to withdraw from an IRA is after age of 60. If you withdraw before age of 59 and a half, you will incur a 10% early withdrawal penalty in addition to taxes on the withdrawal. There are some exceptions of the penalty for medical expenses, disabilities or other unusual life events. Generally speaking, the longer you can wait before taking distributions, the more time to money has to grow. How is 401k plan different from an IRA? Both 401k plan and IRA provide tax advantages to employees investing for their retirement. The main difference is who provides them. A 401k is usually provided by an employer with a contribution automatically deducted from the employee's payback. But some companies will also make their employees' contribution. 401k plans have higher contribution limits, but an IRA can be set up by anyone, regardless of their employer. However, most 401k plans offer a limited range of mutual funds and exchange trade funds (ETF) to choose from, while a typical IRA offers a wide range of funds, stocks and other securities. The bottom line: IRAs are retirement savings accounts that offer tax advantages. They work a bit like a 401k, but they don't require an employer to sponsor them. There are many types of IRAs: traditional IRA, Roth IRA, ACP IRA and simple IRA. There are annual income limitations for deducting contribution to traditional IRAs contributing to Roth IRA. So there is a limit on how much tax you can save by investing in IRA. IRA means a long-term retirement savings account. If you take money out early, you defeat that purpose to deminimizing your retirement assets. That's why money held in IRA usually withdrawn before age 59 and a half, without incurring helping tax penalty of 10% of the amount withdrawn. Complete risk-free with $1 lakh in virtual cash. Then put your trading skills to their next for our free stock simulator, complete with thousands of live Stockpedia traders and trade your way to the top. So submit traders and virtual environment before you start risking your own money. Practice trading strategies so that when you are ready to enter the real market, you have to practice your need. So this is our last topic, that IRA is built for IRA, basic of both IRA, how it works and limits, what is tax differ for savings plan, what is the traditional IRA, backdoor both IRA, what is an Roth 401k, the limits. If you know the all IRAs and different type of IRAs, then I will discuss later. Now today's lesson is completed. You will be next time I will show you the next part of lesson number 5. Take care and please subscribe my channel. Good night.